Greetings to all. Now we are going to understand about accounting treatment of goodwill in the chapter Reconstitution of Partnership. Now, as the formulas for all the four types of finding out valuation of goodwill we have learned in the previous chapter. So now only thing we have to learn is how to find out this. So compute the value of goodwill on the basis of 4 years purchase of average profit based on last 5 years. The profits for the last 5 years were as follows. So here in this basic sum, what we are supposed to do is to take an average of your profits and then you have to multiply with the number of purchase years. So you can see here step number 1, average profit is equal to total profit divided by number of years, and then the next step goes with goodwill is equal to average profit multiplied by number of purchase years. So this way we can conclude with the value of goodwill. Then super profit method. Under super profit method, capital employed in the business 2 lakhs, the normal rate of return given in the sum is 15%, and during the year firm earned a profit of 48,000. Calculate the goodwill on the basis of 3 years purchase of super profit. Now under this there are total 4 steps to be conducted. First is average profit is equal to 48,000 given in the sum. Normal profit, the formula for normal profit is equal to capital employed multiplied by net rate of return. Now net rate of return is 15%, and capital employed is how much? The amount they had invested, that is 2 lakhs at rate 15%, so that gives you 30,000. Now super profit means what? What is super? Super means something extra, what is expected. So super profit is equal to average profit minus normal profit. So we get 48,000 minus 30,000. So finally answer we got is 18,000. Now step number 4, very simple way, super profit multiplied by number of purchase years. So we got 54,000 as our goodwill. Now same way capitalization by super profit method is given. Now under this capitalization of super profit method, capitalization by super profit method, we have to first capitalize the profit. Capitalize by super profit method, we have to first find out super profit as per the method number 2, and then finally we have to find out. So let's understand this particular sum. Rajan and Rajani are partners in the firm. The capital are 3 lakhs and 2 lakhs respectively. During the year a firm earned a profit of 1,50,000. Calculate the value of goodwill on the firm assuming that normal rate of return is 20%. So step number 1, as it is what we have learned, 1,50,000. Normal profit means capital employed multiplied by NRR. So capital employed is over here 3 lakhs plus 2 lakhs, that is 5 lakhs at rate 20% will give you normal profit of 1 lakh. And then super profit is equal to average profit minus normal profit, that is 1,50,000 minus 1 lakh. So ultimately we got 50,000 as our super profit. And then goodwill is equal to super profit divided by NRR multiplied by 100. So here only our formula changes. Super profit divided by NRR multiplied by 100. So always remember, when there is a capitalization of super profit or capitalization of average profit, there will be no availability of number of purchase years. There will be no availability of number of purchase years. So always keep in your mind. This 15 sum is an extra sum I had just given you for the practice. You can see over there. So first you have to find out average profit as per the step. Then find out normal profit after of capital employed. And then super profit. So ultimately we got super profit as 10,000. Right? And then goodwill is equal to super profit multiplied by number of purchase years. So this way we can easily conclude our capitalization by super profit. Now comes capitalization of average profit. A business has earned average profit of 1 lakh during the few years. Find out the goodwill by capitalization method. Given the given that assets of the business are 10 lakhs and external liabilities 1,80,000 and normal rate of return is 10%. So capitalized average profit is equal to average profit divided by NRR. This is new part. Average profit divided by NRR multiplied by 100, and then net assets is equal to total assets minus external liabilities, that is 8,20,000, and then goodwill is equal to step number 1 minus step number 2, that is capitalized average profit minus net assets. So this way we can easily find out our goodwill. Now we are going to learn about accounting treatment for premium of goodwill. Now there are total 7 ways of accounting treatment of premium for goodwill. Now under this very simple way, we are going to discuss in this video 4 major types, and then we will continue with the next video. Now whenever we are starting with the sum, first find it out that is there any old goodwill. That is, old goodwill means the goodwill which is appearing before the admission of a new partner, that is to be written off among the old partners, that is existing partners in their old ratio. So very first entry, goodwill always have a debit balance. So now when we are writing them off, we have to make it credit. So here very first step will be partners capital oblique current account debit to goodwill. So very first step we have to move on with that point. Then comes your all the types of sums which we are going to discuss first, and then we are going to solve the sums. So very first type, when the goodwill premium is paid privately by the partner in sacrificing ratio. When the goodwill premium is paid by the partner but it is privately paid. Word privately here stands means they don't want to show this into the books of accounts, so there will be no entry. Then type 2, when the goodwill premium is brought by new partner in cash and he wants to keep that in the business. When the new partner brings a new goodwill premium in cash and he wants to keep, means retain in the business, then your journal entries will be cash oblique bank account debit to premium for goodwill, means the new partner brought the goodwill premium in the books, that is he is bringing with the form of cash or bank. So cash oblique bank account debit to premium for goodwill, and premium for goodwill account debit to sacrificing partner. Premium for goodwill account debit to sacrificing partner. Always remember, when you are distributing the goodwill, then you are supposed to distribute in the sacrificing ratio. So it will be always in the sacrificing ratio. That is only to be remembered. Next comes type 3. When the goodwill premium is brought by new partner in cash but they are withdrawn by the sacrificing partner, means they are distributing among the partners and then they take away at home, that is they are withdrawing their goodwill premium. So under this, first 2 entries are repeated, that is new partner brings the goodwill and then distributing goodwill among the sacrificing partner. So first entry will be cash oblique bank account debit to premium for goodwill and premium for goodwill to sacrificing partners capital oblique current account. While in the last entry, because they are withdrawing their goodwill premium, the last entry will be sacrificing partners capital oblique current account debit, sacrificing partners capital oblique current account debit to cash oblique bank, means they had withdrawn their goodwill into the for themselves, right? And point number 4, when the goodwill premium is brought by the new partner in kind. Kind means what? They are bringing the goodwill premium in the form of assets. So instead of cash oblique bank, we are supposed to draw asset account debit to premium for goodwill and premium for goodwill account debit to sacrificing partners. Premium for goodwill account debit to sacrificing partners. Right, now we will start with the sum. Now in this 18 sum, we will find all the 4 types of pattern of goodwill premium except asset. Except the last type, we 3 major types are covered. Verma and Sharma are the partners in the firm, sharing profit and losses in the ratio of 5:3. They admitted Ghosh as a new partner with 1/5 share of the profit. Ghosh is to bring in rupees 20,000 as a capital and 4,000 as a share of goodwill premium. Give the necessary journal entries. So here in this particular case, we have 4 patterns which we are going to solve. So when the amount of goodwill is written in the business, so whenever you are starting the sum, first of all you have to take care of these 3 points, and these 3 points covers: find out sacrificing ratio very first, second find out goodwill premium brought by the new partner, and the third point is if all goodwill is existing in the books of accounts, it is to be written off. It is to be written off in their old ratio. So in this particular sum, what will be the sacrificing ratio? So here sacrificing ratio will be the same as old profit sharing ratio, because here in this sum we are available with opening profit sharing ratio, that is old profit sharing ratio, and new partner share. So there will be no finding out of sacrificing ratio. They had sacrificed in the same way. So now we will start with the case number 1. When the new partner brings the goodwill premium in cash and it is retained in the business. So new partner brings the goodwill premium, so entry will be cash / bank account debit to Ghosh capital, that is a capital what is brought down by him, and premium for goodwill what is brought down by him. So this is the first entry we have passed. Then comes your next entry, premium for goodwill account debit to sacrificing partners. So premium for goodwill account debit to sacrificing partners, that is Verma's capital and to Sharma's capital, right? So it will be 2,500 and 1,500 respectively. Always remember that narration is also an important part of sum, so we have to write down narration everywhere. If you are not writing, some or other way your answer will be wrong. Then comes your next point, that is when the partner brings the goodwill premium but it is withdrawn by the partners. So now you are through with this. So when the new partner brings the goodwill, where your entry will be cash / bank account debit to Ghosh capital to premium for goodwill, what we have already passed, what we have already now known with that. Then premium for goodwill account debit to Verma's capital and to Sharma's capital. That is when the new partner brings the goodwill premium and it is distributed among the old partners in their sacrificing ratio. And then last entry, that is when they are withdrawing the goodwill premium. So Sharma's capital account debit, Verma's capital account debit to cash / bank, because they are withdrawing this goodwill premium from the firm. So this way we can pass the entry when the goods are withdrawn by the partners. Then comes your next, when the new partner brings the goodwill, only 50% is withdrawn. When the 50% is withdrawn, same pattern, same sum, only 50% will be highlighting in the sum. So first entry will be cash account debit to Ghosh capital to premium for goodwill, same way. Premium for goodwill is distributed among the partners, sacrificing partners in their sacrificing ratio, and only 50% will be withdrawn. You can see the amount. Here it is 2,500 and of that half, and here it is 1,500 and of that half 750. So it will be withdrawn by them, and finally the answer will be 2,000. And then last pattern, when the new partner brings the goodwill but only they are settling privately. So when they are settling privately, no issues, we don't have to pass the entry, but whatever capital he has brought down in the business, for that we have to pass the entry. So cash account debit to Ghosh capital, and then no entry when the goodwill is paid privately. So this way we have understood the whole logic of this, right? Now we are going to move on with the next sum, that is 19 sum. A and B are partners sharing in the profit and losses in the ratio of 3:2. They decide to admit C into the partnership with 1/4 share in the profit. C brings 30,000 for the capital and requisite amount of goodwill premium in cash. The goodwill of the firm is valued at rupees 20,000. The new profit sharing ratio is 2:1:1. A and B withdraw the share of goodwill, give necessary guarantees. So very first point in this sum is we are available with old profit sharing ratio, new profit sharing ratio, and the firm's goodwill and a partner's capital. Right, so this all items are there. So very first step we have to find out is sacrificing ratio. So by applying the formula old profit sharing ratio minus new profit sharing ratio, we can find out sacrificing ratio. So you can see the solution over there on the screen, right? By taking the LCM of 20, we can get 2:3 as your sacrificing ratio. While the firm's goodwill is 20,000 and she's share of goodwill premium, new partner's goodwill premium will be how much now? It will be taken out from the share of it, that is 20,000 multiplied by 1/4. 20,000 multiplied by 1/4. So this way finally we got 5,000. And now we have to switch on to the guarantees. So what will be the guarantees when the new partner brings capital and goodwill premium? Yes, correct. Cash / bank account debit to seize capital and to premium for goodwill. Right? Now goodwill premium is to be distributed. Goodwill premium is to be distributed among the partners in their sacrificing ratio. So I have distributed them to premium for goodwill account debit to A's capital and to B's capital in the sacrificing ratio, that is 2:3. While at the same time you will see over here in the sum it is mentioned that A and B withdraw the goodwill, right? So they are taking away goodwill for their personal use. So A's capital, B's capital to cash / bank. So last entry, because here the sum pattern is what? When the goodwill is brought by the new partner and it is withdrawn by the partners. Then comes your next sum. Aarti and Bharti are partners and in the firm sharing profits in the ratio of 3:2. They admitted Sarthi with 1/4 share in the profit of the firm. Sarthi brings 50,000 as a capital and 10,000 for his 1/4 share of the goodwill. Goodwill already appears in the book of Aarti and Bharti at rupees 5,000. The new profit sharing ratio between Aarti and Bharti and Sarthi is 2:1:1. Record the necessary guarantees in the books of the new firm. So same pattern, same sum, right? So first of all we have to find out sacrificing ratio. In this sum they had old ratio available in the sum, right? Old ratio 5,000 is available in the sum. You can see over here goodwill already appears in the books as rupees 5,000, right? So when this is old goodwill which is to be written off first, then capital brought down by her and 10,000 for the share of goodwill. So first we have to write off goodwill premium which is already available in the sum, right? So let's move with this. Aarti's capital, Bharti's capital to goodwill, that is write off goodwill in 3:2, that is old ratio. Old goodwill is to be written off in the old ratio. Then new partner brings capital and premium for goodwill. So both entry. So cash / bank account debit to Sarthi's capital and to premium for goodwill. So that is 60,000 in the ratio of 50,000 and 20,000, 10,000 which is available in the sum. And now we are going to distribute them into the sacrificing ratio. So among the sacrificing partners, so premium for goodwill account debit to Aarti's capital and to Bharti's capital. So this way we have located this particular sum. Now comes the next sum, that is X and Y are partners sharing in the ratio of 4:3. They admitted Z for 1/8 share. Z brought 20,000 for his capital and 7,000 for his 1/8 share of goodwill. Subsequently, X, Y and Z decided to show goodwill in the books of 40,000. Show necessary guarantees in the books. So in this sum, old ratio is given and new partner share is given. So we have to directly give sacrificing ratio as old profit sharing ratio. and Z share is 7,000. So very first entry we will be passing is cash oblique bank account debit to Z's capital and to premium for goodwill, and then writing off like retain in the business. So we have to now premium for goodwill account debit to X capital and to Y's capital. So same way we are going to distribute them in their sacrificing ratio. And in the sum they had specifically something mentioned. You can see over here, that is they had mentioned that subsequently XYZ decided to show goodwill in the books of 40,000, right? So when such point is given, in such particular cases we cannot show 40,000, because accounting standard 10 of goodwill says that if money or money value is paid, then only we can show the goodwill, else we cannot show. So they are here raising the goodwill. Raising of goodwill is not valid in the new act. Then comes your type number 5, type number 6 and type number 7. So type number 5 stands with when the goodwill premium is brought, but only some part, like part of goodwill premium is brought by new partner. So in this case we have to extract the remaining amount of premium for goodwill from his personal current account, So here first cash oblique bank account debit to premium for goodwill, whatever amount is brought by him, and then new partner's current account, premium for goodwill account, and to sacrificing partner. So what is the scene over here? That total firm's goodwill is 10,000. Now of which he is able to bring 4,000 only. So rest 6,000 we can extract from his account, that is we are going to debit it, right? And same way in the point number 6, when the goodwill premium is brought by a new partner, when the goodwill premium is not brought by a new partner. So here same application of this will be there, new partners capital oblique current account debit to sacrificing partners, right? And then comes your hidden goodwill. So hidden goodwill I will explain when the sums of hidden goodwill will come. Okay. Now comes 22nd sum. Aditya and Balan are the partners sharing profit and losses in the ratio of 3:2. They admitted Christopher with 1/4 share in the profits. The new profit sharing ratio agreed between A is 2:1:1. Christopher brought 50,000 as for his capital. His share of goodwill was agreed at 15,000. Christopher could bring only 10,000 out of his share of goodwill. Record necessary journalities. So in this particular case, goodwill premium of Christopher is 15,000. Brought by Christopher is 10,000. Total premium for goodwill is how much? 15,000, as we are aware. Now he is able to bring 10,000 only. So 5,000 is yet to be brought by him. So in this case, first OPSR is 3:2 and PSR is 2:1:1, and therefore sacrificing ratio we have to find out. So sacrificing ratio will give you 2:3 as our sacrificing ratio. By applying the logic and factorization method, we can easily find that out. Now comes next. So how we will deal with this? So very first thing, cash oblique bank account debit 60,000 to Christopher's capital. What is capital brought down by him? 50,000. To premium for goodwill. Only the part amount what he can bring, that is 10,000 only, because firm's goodwill is how much? In firm's goodwill his share is 15,000, but he is only able to bring 10,000. So premium for goodwill account debit 10,000, Christopher's capital oblique current account debit 5,000 to Aditya's capital and to balance capital in their sacrificing ratio. Next sum comes is Amar and Samar are partners sharing 3:1. They admitted Kanwar with 1/4 share. Kanwar could not bring the premium for goodwill. He is not able to bring goodwill premium, but goodwill of the firm is valued at 80,000 on Kanwar's admission. Record necessary journalities. So old ratio is given, new partner share is given. In this case, old ratio is equal to SR. Very simple way we have understood. And firm's goodwill is how much? 80,000. Now Kanwar's share is 80,000 multiplied by 1 by 4. As we are aware, he has to bring his share of goodwill only. Now what we are going to do is, from his current account we are going to extract. So converts current account debit to Amar's capital and to Summer's capital. Always remember, when we are taking out the journal entries, we have to take out from the current account only, right? Now this is just a practice sum. Mohanlal and Sohanlal were partners sharing in the ratio of 3:2. They admitted Ramlal with 1/4 share. It was agreed that goodwill of the firm will be valued at 3 years purchase of average profit of 4 years, which were 50,000, 60,000 and 90,000 and 70,000 respectively. Ramlal did not bring his share of goodwill premium in cash. Record the necessary journal entries in the books of Ramlal. Admission: when the goodwill already appears in the books as 2,02,500, goodwill appears as 2,500 and goodwill appears as 2,05,000. So only first entry, writing of the goodwill premium, writing of the goodwill will be changed. Rest of the entries will remain the same. But before that, we will find out the value of goodwill premium of the firm. So by applying the formula of valuation of goodwill, we will find out goodwill amount, that is 2,02,500. Now in this particular case, we have to find out Ramlal's share only. So Ramlal's share is equal to 2,02,500 for 1/4 share. So that gives you 50,625. 50,625. So now the different cases are there which we are going to solve. So very first, goodwill already appears in the books at 2,02,500. So Mohanlal's capital account debit, Sohanlal's capital account debit to goodwill. That is, we are writing off 2,02,500 and making it nullify. We are making 0, right? Because goodwill always have a debit balance. So we are going to credit it. And then rest entry, Ramlal's current account debit, by mistake it is capital, it's current account to Mohanlal's capital and to Sohanlal's capital. Same way, when goodwill appears in the books as 2,500, same writing of 2,500 will be there and rest entry will be the same. And in third case also, when the goodwill appears as 2,05,000, same first entry will be changed with the amount, but rest of the entry will be the same. Okay. Then comes your sum number 25. Rajesh and Mukesh are the partners. They admitted Hari into the partnership, and the new profit sharing ratio between Rajesh, Mukesh and Hari is 4:3:2. On Hari's admission, goodwill of the firm is valued at 36,000 and Hari is unable to bring the share of goodwill premium. So and Mukesh and Hari did not want to show the goodwill. Okay, record necessary journal entries. Here they don't want to show the goodwill premium, but the goodwill which is not brought by new partner, we have to just take it from his current account. So first, old ratio is given in the sum, new profit sharing ratio is given in the sum. So by applying the formulas, we can easily find out sacrificing ratio, that is 1:3. Now firm's goodwill is how much? 36,000. Therefore Hari's share will be how much? 36,000 multiplied by 2/9. That is 8,000. Now Hari's capital oblique current account debit to Rajesh capital and to Mukesh capital. Try that new partner's capital you always write down current while passing the entry of premium for goodwill which is not brought by partner. And this next sum comes, Amar and Akbar are equal partners in the firm. They admitted Anthony as a new partner. 4:3:2 is the new profit sharing ratio. Anthony could not bring his share of goodwill 45,000 in cash. It was decided to be adjustment without opening goodwill account. So same sum, OPSR is equal to 1:1, NPSR 4:3:2. Now just we have to apply sacrificing ratio formula. We got final answer 1:3, right? Now here Anthony's share is given in the sum 45,000. So just 45,000 Anthony's share of goodwill premium and then we are going to pass the journal entries. That is Anthony's capital account debit to capital oblique current account debit to Amar's capital and to Akbar's capital account, and that is 2 in the sacrificing ratio. Right, that ends the sum of goodwill premium, that is like accounting treatment of premium for goodwill. Right, thank you.